Tech is on pace for another week in the green. The Nasdaq looking to secure its fourth positive week in 5. Big tech driving the index to more record highs this week, as you know. And joining us this morning is Janus Henderson, portfolio manager Jeremiah Buckley. Jeremiah, happy Friday. Thanks for the time this morning. Good to see you.
Hey, good morning, Carl. Thanks for having me again.
Before we get to individual names, I'm guessing that double-digit earnings growth affords you some opportunities overall, right?
Yeah, I think it's been a strong second quarter. I think the S&P 500 earnings were up around 13%, and that's following on first quarter up 16%. So the estimates for 2025 now are still in that 12 to 13% range. And what's exciting about that, too, is we've seen a broadening out of the companies that are contributing to that earnings. Not only is AI infrastructure and semiconductors driving strong growth, but we've seen it in financial services, we've seen it in consumer, and in some areas of healthcare. And so that's encouraging to us. We continue to believe that earnings growth will continue, and we are optimistic about the market continuing to go higher.
Right. And so you do like, naturally, in AI infrastructure, some of the big names like Amazon and Microsoft. But of those other buckets you mentioned, what comes to mind first? Is it capital markets?
We do. We are optimistic on capital markets. We think multiples are still in an attractive range, and we think the activity, both currently as well as kind of going forward, will continue to be impressive. You've seen some impressive returns in some of the recent IPOs. We think uncertainty in general in the economy and the market is moderating, and so we'll see more of that business that's in the pipeline come to fruition here over the coming quarters. And so we remain optimistic about companies like Morgan Stanley, Goldman Sachs, who are really well positioned in this environment.
I mean, certainly you see that they would be beneficiaries of, persistence of this type of environment. But you mentioned that you think valuations there are still, pretty attractive. I mean, it seems like they're trading pretty high relative to their own histories, each of them above 2 times book value.
Yeah, so I think the business models have changed over time. They've become more consistent. So the trading revenues have been more consistent than we've seen from volatility in the past. Both those companies have also built strong wealth management businesses, which are also consistent over time. You see a more favorable regulatory environment, which is enabling them to return more capital back to shareholders. So we see the potential for multiples to at least hold and then earnings growth to continue to drive returns. But I also think there's a potential for them to see multiples expand as well.
I'm curious to get your take on travel, because I would argue maybe some of the corporate guidance out of the travel names this quarter has been maybe a little choppy. I'm thinking of an Airbnb, for example, although we were just noticing the Jets, the airline ETF, has had a pretty good week. What's your general sense about the trajectory, the direction of travel within travel there?
Yeah, so we still think it's positive. You look at companies like a Booking, they had 8% room night growth. Delta and United both had more positive commentary about the second half of the year. And so we've seen positive fundamentals. We continue to think that over time, experiences are going to grow faster than goods. Consumers want to continue to get out there and experience the world. And so we continue to be optimistic about travel. And you're seeing what we think is attractive multiples in that space. If you look at in general, around 20 times for most of the companies in that space. And so we're optimistic. A company like Disney, which had really excellent performance in both their parks as well as their cruise lines. And so that continues to give us confidence in that area of the market.
I'm curious what you make about software right now. We were pouring through the 13F filings yesterday and saw a pretty noticeable trend from the second quarter where a lot of the big active managers were rotating out of software, favoring chips. And as I look at your top holdings in both your growth and income fund as well as your balanced fund, it looks like there are some chips, but not much in the way of software as well.
Yeah, so obviously Microsoft is a big position of ours, a big active weight, and so we continue to be optimistic on their software piece, but also the AI infrastructure part of their business. But yes, we're in an interesting period for software in that there's a lot of uncertainty around how AI will impact their business models going forward. Will it reduce the number of seats that are required? And so it's really important for investors to differentiate between those businesses that we think will continue to be relevant in an AI period where they're leveraging AI to improve their products, as well as becoming more efficient internally, but also the companies that are at risk of AI cannibalizing their businesses. And so it's important for investors to differentiate. And I think given this period of uncertainty, you've seen multiple contraction in that part of the market. And so you have to be very picky in parts of the market. We do like companies like Intuit and Microsoft, as well as Oracle in the software space, as we think that they're well positioned in this transition period as we see AI continue to transform business models.
Yeah, we mentioned earlier this upgrade of Salesforce, a sign that maybe some are hunting for some value in that space. Jeremiah, have a great weekend. Always good to talk to you. Thanks so much.